The retirement accounts that millions of Americans are counting on to fund the next 20 to 30 years of their lives are positioned for a monetary environment that no longer exists. And what's coming instead, according to the mathematics of the debt cycle we're entering, will determine whether those retirement savings preserve their purchasing power or quietly erode by 30% to 50% before most retirees even understand what happened to them. The crisis isn't that people haven't saved enough. The crisis is that what they saved in, where they saved it, and what they believe about how it will perform over the next decade is based on assumptions that were true from 1982 to 2021 and are structurally false from 2026 forward. By the end of this analysis, the viewer will understand exactly what changed in the architecture of the retirement system that most financial advisors are still not explaining to their clients, why the traditional 60-40 portfolio allocation is engineered for a deflationary bond bull market that ended 3 years ago, what the mathematics of a $36.2 trillion debt load does to the real return of dollar-denominated assets when interest costs exceed $1 trillion annually, and the one asset class that has historically preserved purchasing power through every monetary transition in the past 100 years when central banks were forced to choose between fighting inflation and servicing government debt. This is not financial advice. This is mechanism analysis. And the mechanism that sustained retirement portfolios for 40 years has reversed. Let's start with what actually happened to retirement accounts in 2022 that most people have already forgotten. The S&P 500 fell 18.1%. The Nasdaq fell 33%. But here's the number that reveals the structural problem. The Bloomberg U.S. Aggregate Bond Index, the benchmark for the investment-grade bond market that represents the safe allocation in every 60-40 portfolio, fell 13%. Bonds and stocks fell simultaneously. That is not supposed to happen. The entire logic of the 60-40 portfolio, 60% stocks for growth and 40% bonds for safety and income, rests on the assumption that when stocks fall, bonds rise because investors flee to safety. In 2022, there was no safety to flee to. Bonds fell harder than they had in any year since 1788. The mechanism that broke in 2022 was interest rate suppression. From 1982 to 2020, interest rates fell almost continuously from over 15% to near zero. Falling rates mean rising bond prices. For 40 years, bonds delivered returns while simultaneously providing the defensive ballast that cushioned stock market corrections. Every financial advisor built their retirement models on that relationship. The relationship no longer holds. Here's where things get important. The number that determines whether bonds can play that role again is not the current Fed funds rate. The number is $36.2 trillion. That is the current level of U.S. federal debt. The interest cost on that debt at the current average rate of approximately 3.5% is over $1.2 trillion per year. That is more than the defense budget. That is more than Medicare. That is the first time in American history that interest expense has exceeded every discretionary spending category. The arithmetic of that debt load makes the interest rate environment of the next decade structurally different from the environment of the past 40 years. In the 1980s and 1990s, the U.S. could afford to let interest rates fall because the debt level was manageable. Falling rates reduced the government's borrowing costs, which gave the Federal Reserve room to ease policy during recessions without creating a fiscal crisis. In 2026, the situation has inverted. The debt load is so large that even modest interest rates produce interest costs that crowd out every other category of government spending. The Federal Reserve is trapped between fighting inflation, which requires higher rates, and avoiding a fiscal crisis, which requires lower rates. That trap has a name. It's called fiscal dominance, and it is the condition that has preceded every major debasement of a reserve currency in modern monetary history. Let me walk through what fiscal dominance means for a retiree holding a traditional portfolio. A 65-year-old retiring in 2026 with $1 million in a 60-40 portfolio, $600,000 in an S&P 500 index fund, and $400,000 in an aggregate bond fund is making several implicit bets. Bet 1, that the Federal Reserve will be able to cut interest rates during the next recession without triggering an inflation spiral. Bet 2, that bond prices will rise during that rate-cutting cycle, providing the defensive cushion the portfolio needs. Bet 3, that the dollar's purchasing power will remain stable enough that the 4% withdrawal rate financial advisors recommend will actually fund 25 to 30 years of expenses. All three bets depend on the Federal Reserve maintaining control of the monetary system, and the mathematics of the debt cycle suggest that control is slipping. Layer 1, the refinancing wave that nobody is discussing. Over the next 5 years, the U.S. Treasury must refinance approximately $17 trillion in maturing debt. That is not new borrowing. That is simply rolling over existing obligations. At current interest rates of 4% to 4.5%, the annual cost of servicing that debt will rise by hundreds of billions of dollars compared to the near zero rates at which much of that debt was originally issued. The Treasury is locked into a rising interest cost trajectory, regardless of what the economy does. If the Fed cuts rates to fight a recession, inflation expectations rise, which pushes long-term bond yields higher, which increases the Treasury's borrowing costs. If the Fed holds rates steady to fight inflation, the economy slows, tax revenues fall, and the deficit widens, which also pushes borrowing costs higher. Every path leads to the same outcome: higher structural deficits financed by a bond market that is already questioning whether U.S. debt is a risk-free asset. The bond market's questioning is not theoretical. It shows up in the data. The term premium, the extra yield investors demand to hold long-term bonds instead of rolling over short-term bonds, has risen from deeply negative in 2020 to positive in 2024. That shift represents a fundamental repricing of risk. Bond investors are demanding compensation for the possibility that inflation stays elevated, that the Fed loses credibility, or that fiscal policy becomes unsustainable. When the term premium rises, it means the bond market is charging the government more to borrow for longer periods. That is a vote of no confidence delivered not through headlines, but through basis points. Layer 2, the demographic collision. The Social Security Trust Fund is projected to be depleted by 2034. Medicare's Hospital Insurance Trust Fund faces insolvency by 2031. These are not predictions. These are the official projections from the Social Security and Medicare trustees' reports. When those trust funds are exhausted, the government will face a choice: cut benefits by approximately 20% to 25%, which is what the current revenue stream supports, or increase general revenue funding, which means larger deficits, more borrowing, and more pressure on interest rates. The demographic wave of 65 million baby boomers retiring between 2020 and 2030 is not a hypothetical future event. It is happening right now, and it is structurally increasing the fiscal pressure on a government that is already running trillion-dollar deficits during an economic expansion. The Congressional Budget Office projects that by 2033, mandatory spending on Social Security, Medicare, and Medicaid plus interest on the debt will consume 100% of federal revenue. Every dollar of defense spending, infrastructure, education, and everything else the government does will need to be borrowed. That is not a sustainable fiscal path. That is the arithmetic of a system approaching a breaking point. Layer 3, the inflation-deflation pendulum. The retirement planning industry has spent 40 years optimizing portfolios for a deflationary world. Low inflation, falling interest rates, rising bond prices, and steady equity appreciation. That was the 1982 to 2020 regime. The 2020 to 2026 regime has been different. Inflation spiked to 9.1% in June 2022. The Fed raised rates from 0% to over 5% in 18 months, the fastest hiking cycle since the 1980s. Even after falling back to approximately 3%, inflation remains above the Fed's 2% target. More importantly, the structural forces that kept inflation low for 40 years, globalization, cheap Chinese manufacturing, declining energy costs, suppressed wages, have reversed. Deglobalization, reshoring, energy transition costs, and tight labor markets are all inflationary. The pendulum has swung, and portfolios built for deflation are now operating in an inflationary regime. Here is what that means for the traditional retirement portfolio. The 60-40 allocation was engineered for the 1982 to 2020 environment. Stocks provided growth. Bonds provided income and rose when stocks fell. Inflation stayed low, so the purchasing power of the portfolio remained stable. In a fiscal dominance regime where the government cannot afford high rates but also cannot afford high inflation, neither stocks nor bonds provide reliable protection. Stocks face margin compression as input costs rise and consumer spending slows. Bonds face capital losses as yields rise to compensate for inflation risk and fiscal concerns. And the dollar, the denominator in which both assets are priced, loses purchasing power as the Fed chooses the politically survivable option, allowing moderate inflation rather than triggering a debt crisis. The retiree who believes their $1 million portfolio will generate $40,000 per year in real income for 25 years is assuming that the next 25 years will resemble the past 40. The mathematics of the debt cycle say otherwise. If inflation averages 4% instead of 2% over the next decade, the real purchasing power of that $40,000 annual withdrawal falls by 32% by year 10. The retiree is still receiving $40,000 nominally, but it buys what $27,000 bought in year 1. That erosion is silent, gradual, and devastating. And it is exactly what happened to retirees in the 1970s who entered retirement assuming inflation would stay at 2% and instead watched it run at 7% to 9% for most of the decade. Now let me address the question that every retiree and pre-retiree should be asking. If the traditional portfolio is positioned for the wrong regime, what allocation is positioned for the regime we're entering? The answer requires understanding what actually preserves wealth during monetary transitions, and the historical record is unambiguous. In every major monetary transition of the past century, when governments carried unsustainable debt loads and central banks lost the ability to control both inflation and interest rates simultaneously, one asset class consistently preserved purchasing power. It was not stocks. Stocks fell 89% from 1929 to 1932. It was not bonds. Bonds were devastated during the 1940s inflation and again during the 1970s stagflation. The asset that preserved wealth was the one with no issuer, no counterparty, and no dependence on government fiscal discipline: gold. From 1971 to 1980, during the last sustained period of fiscal dominance and dollar debasement, gold rose from $35 per ounce to $850 per ounce. That is a 2,329% gain. A retiree who held 10% of their portfolio in gold during that period preserved the purchasing power of that allocation, even as inflation eroded the real value of their bonds and stocks struggled through a decade of stagnation. The gold allocation was not speculative. It was insurance against the exact scenario that is unfolding today: a government with debts it cannot service at high interest rates and a central bank forced to choose inflation over insolvency. Here is the mechanism that most financial advisors either don't understand or won't explain. Gold does not produce cash flow. It does not pay dividends or interest. In a regime where bonds pay 5% and inflation is 2%, holding gold has an opportunity cost. You're giving up 5% per year to hold an asset that just sits there. But in a regime where bonds pay 4% and inflation is running at 3% to 4%, the real yield on bonds is zero or negative. In that environment, gold's lack of yield is no longer a disadvantage. It becomes a feature. Gold cannot be debased by a government running deficits. It cannot be diluted by a central bank printing money. It has no credit risk, no duration risk, and no dependence on the competence of policymakers. The institutional investors who manage sovereign wealth funds and central bank reserves understand this. That is why central banks purchased 1,037 tons of gold in 2023, 1,045 tons in 2024, and 863 tons in 2025, despite gold prices rising throughout that period. They were not buying gold because it was cheap. They were buying it because they assessed that the dollar's purchasing power would decline over the next decade, and that gold was the only asset that could preserve value through that decline without counterparty risk. The retiree who allocates 0% to gold is implicitly betting that the United States will navigate a $36.2 trillion debt load, a $1.2 trillion annual interest expense, a Social Security insolvency crisis, and a demographic wave of retiring boomers without any meaningful erosion of the dollar's purchasing power. That bet might prove correct, but it is a bet. And it is a bet that institutional capital is not making. Let me now walk through what a structurally sound retirement allocation looks like in a fiscal dominance regime. This is not a recommendation. This is an explanation of how portfolios are being repositioned by investors who understand the mechanism. The traditional 60-40 portfolio holds 60% equities and 40% bonds. In a deflationary regime, that allocation makes sense. Equities grow, bonds provide safety and income, and inflation stays low. In a fiscal dominance regime, that allocation leaves the retiree exposed to simultaneous losses in both stocks and bonds, exactly what happened in 2022. A regime-adjusted allocation recognizes that bonds no longer provide reliable defense. The 40% that was in bonds needs to be reallocated to assets that preserve purchasing power when inflation rises and fiscal credibility falls. For many institutional investors, that reallocation looks like this: 50% to 60% in equities, focused on companies with pricing power, hard assets, and international revenue diversification. 10% to 20% in gold or gold-related assets, not as a speculation, but as insurance against dollar debasement and fiscal crisis. 10% to 20% in inflation-protected securities or real assets, commodities, infrastructure, real estate in supply-constrained markets. 10% to 20% in short-duration bonds or cash equivalents, providing liquidity without the duration risk that devastated long-term bonds in 2022. The shift is subtle but critical. The portfolio is no longer optimized for steady income in a low-inflation world. It is optimized for purchasing power preservation in a world where governments have debts they cannot service without eroding their currencies. Here is what the viewer needs to understand about timing. The window to make this adjustment is not infinite. Once the fiscal crisis becomes visible to the general public, once bond yields spike because foreign creditors stop buying treasuries, once the Fed is forced to choose openly between defending the dollar and bailing out the government, the assets that provide protection will have already repriced. Gold will not be $2,600 per ounce. It will be $4,000 or $5,000 or higher. Inflation-protected assets will no longer offer the entry points they do today. The time to reposition a portfolio is before the crisis becomes undeniable, not after. The institutional investors repositioning now are not reacting to headlines. They are reading the debt maturity schedules, the Social Security trustee reports, and the Federal Reserve's balance sheet. They see the same arithmetic that anyone can see if they look. A government that cannot afford high rates. A central bank that cannot cut rates without risking inflation. A bond market that is beginning to question whether U.S. debt deserves its risk-free status, and a retirement system that is still allocated as if none of that matters. The data is already visible to anyone willing to examine it. In the first quarter of 2024, foreign holdings of U.S. Treasuries declined by $52 billion. Japan, historically the largest foreign holder, reduced its position. China continued its multi-year trend of selling. These are not panic sales. These are measured portfolio adjustments by sovereign reserve managers who see the same debt trajectory and are quietly reducing exposure before the market forces them to. When institutions move slowly and deliberately out of a position, it signals they have made a structural assessment about risk, not a tactical bet on the next quarter. The uncomfortable truth is this: the retirement crisis that is coming is not a crisis of savings. Americans have saved. The crisis is that what they saved in, stocks and bonds denominated in dollars, is positioned for a monetary regime that ended in 2020. The regime we are entering, fiscal dominance, rising structural inflation, and dollar debasement, requires a different allocation. And the retirees who understand that difference will preserve their wealth. The ones who do not will watch their purchasing power erode and wonder why their financial advisor never explained what was happening. One type of retiree will enter the next decade holding the same 60-40 portfolio they were told to hold in 1995. They will watch bonds fail to provide defense during the next equity drawdown. They will see their real purchasing power decline as inflation runs ahead of their portfolio's nominal returns. And they will learn too late that the mechanism that sustained retirement portfolios for 40 years reversed in 2022. The other type of retiree understands that wealth preservation is not about chasing returns. It is about matching portfolio structure to the monetary regime. In a deflationary regime, bonds and stocks work. In a fiscal dominance regime, hard assets and assets with no issuer work. The mathematics of the debt cycle has already determined which regime we are in. The only question is whether the retiree adjusts their allocation before the mechanism completes its reversal. This was not a portfolio recommendation. It was not a prediction of market crashes or currency collapses. It was an explanation of the mechanism that determines whether retirement savings preserve purchasing power during a monetary regime shift. The debt load is $36.2 trillion. The interest cost is $1.2 trillion annually. The refinancing wave is $17 trillion over 5 years. The Social Security Trust Fund depletes in 2034. These are not opinions. They are published government data. The traditional retirement portfolio was built for the 1982 to 2020 regime. That regime ended. The regime we are in now requires a different allocation. The institutions managing sovereign wealth have already made that adjustment. The question every retiree should be asking is whether their portfolio has made it too. Most have not. Now the viewer knows why they should.